Nvidia looks like one of the most obvious winners in the market today. But the real investor question is not just, is Nvidia a great company? The better question is, what did Nvidia build over 30 years that lets it turn the AI boom into earnings? This video is the Nvidia story from the beginning to now. The graphics startup, the GPU category, CUDA, AI supercomputers, networking, data centers, and finally the stock corridor investors have to understand. Quick ask before we get into the model. If this kind of research helps you, please subscribe to Intuitive Investor and tap like. It tells us to keep doing the work, reading the releases, building the valuation model, and turning the story into simple price ranges. And comment with your Nvidia view, reset, base, or bull. Now the thesis. Nvidia did not get lucky with AI. Nvidia spent 3 decades compounding one architecture. Nvidia was founded in 1993 by Jensen Huang, Chris Malachowski, and Curtis Preem. The original bet was visual computing. At the time, graphics looked like a PC gaming and workstation niche. But underneath that niche was a bigger idea. Visual computing requires massive parallel processing. Investors should notice this pattern. The best platform companies often start in a narrow market, then expand when the same capability becomes useful somewhere much larger.
In 1999, Nvidia helped define the modern GPU category. That mattered because the company was not only selling faster graphics cards, it was learning how to build processors that handle thousands of smaller calculations at once. Gaming made the hardware better. Workstations made the software better. And every cycle created more developers, more tools, and more installed base. Long before generative AI, Nvidia was building a parallel compute machine.
The second turn was CUDA. Hardware creates value, but software makes that value sticky. CUDA made GPUs programmable for developers, researchers, and later AI teams. Then the deep learning wave made the advantage visible. When neural networks needed huge parallel compute, Nvidia already had the chips, the software layer, the libraries, and the developer habit. This is why the moat is not only transistor performance, it is the accumulated workflow around the silicon. The third turn was systems. Nvidia moved from selling boards and chips to selling complete AI infrastructure. DGX showed customers a turnkey way to train deep learning models. Mellanox added the networking layer needed to connect many accelerators into one large compute fabric. That is a major investor lesson. The bigger the AI workload became, the more the buyer needed a complete stack. Nvidia moved up from component supplier to platform provider. Look at the revenue staircase. Nvidia revenue was roughly $27 billion in FY2022. It reached about $216 billion in FY2026. Consensus estimates now model roughly $376 billion in FY2027. That is not normal semiconductor cyclicality. That is platform demand meeting a new infrastructure build-out. The important question is whether this growth is a pull forward that fades or a new compute base that keeps expanding. The latest quarter keeps the story fresh. Q1 FY2027 revenue was about $81.6 billion. Data center revenue was about $75.2 billion, and the Q2 guide is around $91 billion. The investor translation is simple. Nvidia is not just selling accelerators into one product cycle, it is selling the factory stack for AI compute. Chips, racks, networking, software, and deployment patterns. That is why Nvidia's success has several layers. First, silicon. Second, CUDA and software libraries. Third, systems like DGX and rack-scale infrastructure. Fourth, networking and the ability to scale clusters. A competitor can attack one layer. It is much harder to replace the whole habit stack at the same time. That is the reason investors give Nvidia a premium multiple when they believe earnings are durable. Now the corridor. At a current price around $223, consensus FY2027 EPS of $8.47 implies about 26 times forward earnings. On FY2028, consensus EPS of $11.57, the same stock is closer to 19 times. If the market pays 28 times FY2028 earnings, the base corridor is about $324. A reset case is closer to $250. The $500 case needs high EPS, around $15, and a premium multiple near 34 times.
Today investment decision, direct and balanced.
So is Nvidia good to invest in today? Here is the clean investor answer. At about $223, the stock is not cheap in a traditional sense, but it is not priced like the full bull case either. The reset zone near $250 is only about 12% above today's price. The base zone near $324 is about 45% upside. The bull zone above $500 is more than double, but it requires high EPS and a premium multiple. Buying today makes sense only if you believe three things. AI factory demand keeps expanding, FY2028 earnings are durable, and Nvidia's platform moat protects margins. If you do not believe those three things, the valuation has very little room for disappointment. The risks are real. The first risk is valuation. Earnings can rise while the multiple falls. The second is AI CapEx digestion. Large cloud customers may pause or slow new orders. The third is export controls, especially around China. The fourth is competition from custom ASICs, AMD, and internal cloud silicon. None of these risks erase the story, but they decide which corridor the stock trades in. So the investor lesson is this: study the story, then study the EPS. Nvidia becomes investable today when you believe the platform can keep converting AI compute demand into durable earnings. If that belief holds, the base corridor can move above $300. If EPS breaks or the multiple compresses, the stock can reset. If this model helped, subscribe, like the video, and comment with your Nvidia price corridor. Share it with someone studying NVDA and tell us which stock to model next.